What is going on, traders? So much to get into today. PCE inflation just came in steaming hot. This is the index that the Fed says that they prefer over the CPI. Although in this case, I think they would much rather take the CPI over PCE, considering how hot PCE came. Looking at the S&P 500, we are now back under the neckline of the inverted head and shoulders. And we today also gapped down below the October 2022 trend line. Remember, this was the bottom so far in the bear market, and stocks have been rallying since then on hopes that we get a soft landing. But looking at where PCE came in, looking at where now the Fed funds futures are predicting almost at a 50-50 rate that the Fed now does a 50 basis point rate hike. The fact that stocks are now in the death zone, according to Morgan Stanley, I will get into exactly what this means. And we see bond yields rising once again with the 10-year hovering at the 4% mark. So much to get into here. And I will, of course, go over my plays towards the end of the video, so you definitely don't want to miss it. And for those of you that follow me on Instagram and Twitter, shout out to you guys. Hopefully you took this meta short, this short on Facebook here that I posted on February 10th. It hit our first target today. I gave this to y'all for free. So make sure you are following me on Twitter and Instagram for free daily trading and finance content. And let's get right into it. So as I said, PCE came in hot. This is the gauge that Jerome Powell claims that the Fed looks at more than the CPI. This is the Personal Consumptions Expenditures Index. But if you look at this, this is for January 2023, which the numbers came out today were for January. We are actually ticking back up. Now let's dive into the numbers just a little bit more. 0.6% month over month. Expected was 0.4%. 5.4% year over year. The expected was 4.9%. So we're trending drastically in the other direction. Core PCE, this strips out volatile prices for food and energy. We are getting 0.6% month over month, again, versus 0.4% expected, but 4.7% year over year versus 4.3% expected. So even when you strip out the prices that are considered volatile, we are still way higher than estimated. Of course, the market reacting violently to this today. The NASDAQ is down 2%. The S&P, as you see here, down 1.5%. And you guys know that I've been following this inverse head and shoulders. We did pop above on really hopes of a soft landing. However, because I was looking at the Fed funds futures, because I was looking at the bond market, in my view, in my estimate, and for those of you that follow this channel know this, I was saying that the stock market looks like it's lagging. And when you have names like ARK, Roku, DocuSign, all of the high beta names, all of the AI plays, especially going up, the chip names going up, we saw increases in some stocks by 50, 60, 100%, while the bond market was showing increased pressure. And really the fact that they surrendered to the Fed is showing that bond yields were going up. And Fed funds futures were going up, expecting that the Fed would now do a more than 5% federal funds rate. Obviously, the bond market taking a look at economic indicators such as wage growth, job growth, as well as the fact that CPI came in revised higher than expected for the last 5 months. So even though we popped above this, for me, the timing in which we popped above this was right around CPI, FOMC, and now PCE. When I looked at the Fed funds futures market and I looked at the bond market, for me, I was comfortable selling here because a lot of stocks that we bought back in October were up again 50, 60, 100%. And for me, it was not worth the risk of staying in those stocks with all of that uncertainty, with the bond market predicting what it was predicting, with the Fed funds futures predicting what it was predicting. And I was okay selling here, regardless of whether we went up or not. All of my decisions are public. You can check back on my videos. And for those in the Academy, you could check obviously in the Academy as well. Here's timestamped February 6th, talking about I was going to be selling the stocks that I bought in October because of the uncertainty. We hadn't yet popped below that head and shoulders, not even close, that inverse head and shoulders. We actually just broke out of the trend line, and I still had really high conviction in my thesis for selling here in the face of so much uncertainty to lock in all of those gains. I also had a short on individual names such as Meta. We closed our puts on Tesla as well. If you want access to all of our trades, my long-term analysis, if you want to know when I'm buying, when I'm selling, we seem to have caught the bottom and the top of this rally so far. Obviously, nobody knows what happens well into the future, but so far in the short term, we seem to have caught that and maximized our gains in this bear market. Make sure you apply to the academy below. Answer the questions. If you are accepted, you will get a response back. Anyway, let's get into the rest of the video. So in terms of where I see the market going at the moment, from a technical perspective, we did cross finally below that October trend line. So this is the rally that was really based on a number of things: short squeezes, the fact that a lot of fund managers didn't put money to work because they were waiting on more of a bottom, but then they were forced to load in during the beginning of this year, which is why you see this major rally in January. And also the hopes and the talks of a soft landing, I think, really roped in a lot of retail traders, especially after breaking out of this trend line. And I know from my own audience, anecdotally on Twitter and on YouTube, a lot of you were telling me that you actually started buying stocks here, which unfortunately is how most of retail trading works. Whether I'm right or not about this being the interim top, for me, I would never buy this, right? For me, I'm much more comfortable buying on the way down. I'm more comfortable buying in the red. For instance, I would be more comfortable buying here than when a lot of traders started buying here, right? It's just how I've tuned my brain over the years, and I will be making a video about trading and investing psychology soon. Other factors I'm looking at, let's take a look at the S&P 500 dividend yield. Right now, if you take the dividend yield on the culmination or the collection of S&P 500 stocks, you're only getting about 1.74 as the yield. If you take a look at the earnings yield, the earnings yield is only 4%. Right? This is the EPS of the total S&P 500 over the price of the total S&P 500. If you take a look at the forward earnings yield, you are also hovering above, a little bit above 4%. So that is why when you see something like the Morgan Stanley equity risk premium, this is basically the risk of buying now based on the S&P 500 yields, right? Versus the risk of buying something risk-free, which offers a similar yield. That is essentially what this Morgan Stanley equity risk premium is calculating. And right now we are in the death zone. And so if you look at back in October, we were in a much better position back when I said I was comfortable buying stocks, because the risk, at least if you calculate the S&P dividend yield or the S&P earnings yield, the risk was much better than investing at the time in something risk-free like a treasury. But right now, with treasury yields rising, are you better off investing in the S&P 500 when we don't know what the future conditions are going to be like as it relates to inflation? It looks like inflation is ticking back up. When we now don't know what the Fed is going to do in terms of rates, now it looks like the higher for longer is a reality based on the economic data points that came out. Are you better off investing in the S&P 500 here in the face of rising yields, when you can invest, for instance, in a 4-month treasury and get 5% yield, or a 3-month treasury and get 4.84% yield? I just put a lot of money, by the way, in 1-month, 2-month, and 3-month treasuries, creating my own bond ladder. But are you better off putting your money in the S&P 500 in such precarious situations, or are you better off putting it in a risk-free treasury? And that's essentially what this is measuring here by Morgan Stanley. We are now in the death zone because investing in equities right now, based on the yield that it's offering, from the dividends itself, but also if you just look at the earnings per share over price, the yields on treasuries are much more attractive than the yields on equities. And if you look at inflation swaps, I won't get into this data heavily, but if you look at inflation swaps, you could see that all across the board for March and February, inflation swaps have ticked up sharply, meaning that inflation traders are betting that inflation starts going up. Remember that on March 14th, we have CPI again. And if CPI shows that we are going up once again, if it shows that it's ticking higher on CPI, then not only do I expect the Fed to do potentially a 50 in March, the Fed March meeting is March 22nd, But I also expect the S&P 500 at that point to potentially visit near the October lows, right? I don't know if we will take out the lows. We might need yet another month of rising inflation. But if the last CPI came in hot, this PCE came in hot, the next CPI comes in hot, then the narrative of a soft landing is out the window, right? Completely out the window, because it shows, as a matter of fact, that inflation is stickier, and we've never fought inflation in this country without going into a recession, and we will be forced to enter a recession almost certainly. So March 14th, obviously it's a ways away. We will be streaming live. But if the next CPI comes in hotter than expected, then I do expect to get near these October lows. Whether we take them out or not will depend on how drastic inflation is and how hard the Fed goes on March 22nd. But with that said, am I comfortable selling my shares here, being able to sleep at night? Yes, of course I'm comfortable selling my shares here. As the great Jesse Livermore once said, sell your shares down to the sleeping level. The sleeping level is where you are comfortable putting your head at night, knowing that your portfolio isn't going to tank to oblivion. Now, in terms of when, before I end the video, in terms of when I will buy back, I'm not in a rush to buy back until we see what happens with the next inflation data. I don't think that the market really can rally here exuberantly. We may get up and down days. We may, chop into oblivion until the next CPI date, but I'm not in a rush to buy stocks here until I see what the next CPI yields, right? I don't think this is an optimal level. So I would happily wait until March 14th to see what happens before thinking of buying stocks again. In terms of plays, I'm still in the Meta short. I will likely, I took partial profits already, but I'm looking for Meta to close this gap. It may get ugly until then, especially since we're at the 0.5 fib level. One of our analysts posted a trade on SOX S, which is up nicely. This is the inverse of the semiconductor ETF. This is the bear version of the semiconductor ETF SOX L. I do have an open short on ExxonMobil, which is currently up as well. And I likely will wait for a retracement on the S&P 500 and the NASDAQ before taking another short. I would likely wait for it to hit back this trend line before taking a short from there. Anyway, traders, that is it for this video. If you got something out of this video, let me know in the comment section below. Do you think that inflation will be stickier than expected? Do you expect the market to revisit the October lows? Are you buying here? Are you selling here? I love hearing from you guys. Also, again, if you want access to all of our trades, all of the courses, over 60 plus videos of courses, how to day trade, how to trade options. If you want access to the Zoom masterminds with me, which you get lifetime access to if you are approved for the Academy, sign up. Link is in there below. Apply to the Academy. If you're approved, we will let you know. We will reach out to you and let you know. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.